Welcome at Morningstar. My name is Peter Bayel, and today I'm talking with Oliver Kettlewell, fund analyst with the Morningstar Pan-European Fund Research Team, and we're going to talk about emerging market debts. Oliver, welcome.
Thanks, Peter.
So, Oliver, emerging market debt is quite a strange category. Not everyone is invested in it. Maybe you can give a bit of background about emerging market debt and who should be invested in it.
Yeah, you're right, Peter. It's not one of our most popular categories. Not many investors really know too much about this category. When investors think about investing in emerging markets, they tend to go for the equity of emerging markets rather than the debt. But I think that debt is becoming increasingly important as a sort of asset class for emerging markets, and it could be a viable option for investors to use in their investment portfolio.
One of the elements that we have previously always seen in emerging market debt and in debt in general are default rates, and among emerging market countries, these were always quite high. Do you think the risk is worth investing in?
Yes, emerging market debt has always had a history of having its defaults. So I mean, you're right in that sense. I mean, there was Mexico in the 1980s, there was Russia in the 90s, and I think Argentina in 2001, and I think Ecuador was most recently. But you know, I think the fundamentals are improving, and compared to developed markets debt, then emerging market debt is becoming more attractive. If you think about what drives the economy of emerging markets, then they're sometimes driven by sort of export-driven commodities, and commodities have generally shown price appreciation in the last few years. So, you know, a lot of these emerging market countries have sort of solid balance sheets in the background to back up payments of their debt.
So, Oliver, with the current market circumstances, we see Greece, we see Portugal. Would you consider them more risky, less risky than emerging market debt?
I think that these are all developed economies, so in that sense they will always be less risky than emerging market debt. But I think we do see this sort of shift in risk gradually happening. I mean, if you look at a lot of developed markets, the ones that you talked about, a lot of them had exposure to this bad debt, these bad loans, and they've sort of got debts now that they're going to have to repay over a long period of time. And a lot of emerging market countries didn't have this exposure to this sort of these bad debts that developed markets did. So in that sense, they are better placed. And whether that will pan out in the future, we don't necessarily know. But certainly it's becoming more even now, yes.
It depends on how the European Union further reacts to these bad debts
also,
in the
yes.
developed markets.
Yes, you're right.
What about the place in a portfolio for investors? Investors who want to take the higher risk. What kind of a portion should they invest their assets in emerging market debt?
Yeah, I think it's important not to lose sight of the big picture here. You know, I mean, we're not saying that this emerging market debt category should be used as the core in your investment portfolio, but I do think it's quite a good sort of a fund from this category is quite a good use as a niche player, as a sort of supporting player.
Diversifier?
Yeah, as a diversified sort of to give diversification towards that core investment probably that you have in your portfolio. If I can give an example of correlation, I looked at some correlation statistics regarding this category and other core categories, and the correlation for this category relative to Dutch equity, for example, is 0.7. And that also is the same figure for European equity and global large cap equity.
And that's a very low figure.
That's relatively low. I mean, if we then compare it to emerging market equity, that has a correlation of 0.9. So you can actually see that this other emerging market category has a lower correlation compared to the traditional emerging market category that a lot of people have actually.
And maybe just out of interest, a lower correlation, maybe it's good to kind of explain what that means between asset classes.
Yeah, I mean, ideally, I mean, correlation goes from -1 to +1, as you all know. So ideally, I mean, you really want a negative correlation, but that's very, very difficult to have.
Negative correlation, you mean that when one market goes down, for example, when the developed markets go down, that emerging markets or any other negative correlated asset class would go up, so that you have a diversification away and not everything goes down when markets go down, right?
Yes, you're right. And I think in an ideal situation, obviously we want negative correlation between categories. But having said that, 0.7 is relatively low compared to the other categories, many other categories that we have in the Morningstar database. So in that sense, I do think that this category of emerging market debt is a good supporting player towards your core portfolio that you have in your investment portfolio.
Okay, and looking at the past, do we see that indeed emerging market debt has done relatively well compared to other categories? How do, of course, the past returns don't say anything about the future, but how have they stack up in recent years?
Yeah, I think returns have done quite well relative to other categories. I think we have a graph that we can look at now to illustrate that.
Yep. Please explain what the graph is showing.
So we can see from this graph that it's got the emerging market debt category and the emerging market equity category, the emerging market equity category which most people have. But actually both categories have seen an upward trend over the past few years that this graph shows. But what you can actually notice from the emerging market debt category, which is interesting, is that it has a lower volatility in returns. And I can just put some absolute figures on this. The standard deviation of returns for the emerging market debt category is just 9%, whereas for emerging market equity, it's over 20%. And
in absolute numbers, is this 9% not a lot for debt instruments?
Yeah, it is for debt instruments, but then if you add in the fact that it's emerging markets, you would expect it to be a bit higher, I think. So I think 9% is a reasonable sort of standard deviation to have if you consider alongside that it's had returns comparable to the emerging market equity category.
So the category has held up relatively well, has lower volatility. Maybe go into the nitty-gritty of emerging market debt funds. What do you look at with the Morningstar research team when you're looking at emerging market debt funds?
Yeah, I think there's two different ways that you can play emerging market debt. There's, on the one hand, you've got the local currency funds, and the other hand, you've got hard currency funds.
And hard currencies meaning euro, dollar.
Exactly. And these are the ones that are slightly more risky compared to the local currency funds, because it's always easier to fund debt payments in your own currency compared to having to go and buy dollars and buy euros in the foreign exchange markets if your own currency is not doing so well. So local currency has a lower risk profile, and the hard currency has a higher risk profile.
Okay, Oliver, thank you very much. In the next movie, we're going to talk about two emerging market funds, one local currency, one hard currency. For now, I thank you for watching. This was Peter Bayel with Morningstar. Thank you very much.